Have you ever wondered why people would pay an absolute fortune for something like a single flower bulb? Or, get this, a company that shoots square cannonballs? Well, today we're going to take a random walk down Wall Street, inspired by Burton Malkiel's classic book, to really get into the psychology, the madness of market bubbles. Let's get right into it.
You gotta love Mark Twain. His wit here just kind of perfectly captures how trying to outsmart the market is this timeless and, let's be honest, often foolish game. But what really drives these wild cycles of boom and bust? Well, it all comes down to this fundamental clash in how we even think about an investment's value.
So you've really got two competing ideas. On one hand, you have the firm foundations theory. This is your logical spreadsheet and calculator approach. It says every stock, every asset has a real intrinsic value you can figure out. Your job is to calculate that value and buy when the price is a bargain. But then you have the much more seductive castle-in-the-air theory. And this one, it's all about psychology. It says an asset is worth whatever the next person is willing to pay for it. So your goal isn't to analyze earnings reports, it's to guess what the crowd is going to do next.
And that, right there, is the central battle we're looking at today. It's the conflict between a solid, firm foundation of value and a beautiful but incredibly fragile castle built in the air.
Now, this castle-in-the-air theory also goes by another, let's say, less charitable name, the greater fool theory. The logic is simple and pretty cynical. You can pay a totally ridiculous price for something because you're betting that there's an even greater fool out there who will come along and buy it from you for even more. It's a really dangerous game of musical chairs, except, it's played with your life savings.
To really see how this plays out, let's hop in a time machine. Because you might be surprised to find out that our ancestors, centuries ago, were just as likely to get swept up in speculative madness as we are today. Okay, so our first stop is Holland, way back in the 1630s. And the mania wasn't about some new technology. It was about tulips. Yeah, tulip bulbs. See, a virus called mosaic created these stunning, unique, flame-like patterns on the petals. And these special infected bulbs, they became the ultimate status symbol. This wasn't just about gardening. It was about showing off and a deep-seated fear of missing out as your neighbors got rich. Pretty soon, the whole country, from nobles all the way down to chimney sweeps, was gambling on the price of flowers.
And the absurdity just went off the charts. In January 1637, the price of some tulip bulbs shot up 20 times over in a single month. People were trading their homes, their land, their entire life savings, all for one single flower bulb, because they truly believed they had found the easiest path to unimaginable wealth.
All right, let's fast forward a bit to 18th century England and the infamous South Sea bubble. Here, public gullibility hit an all-time high. I mean, one of the most famous examples was a company that was raising money to build a cannon that fired square cannonballs. The promoter promised huge returns, collected everyone's cash, and then, you guessed it, vanished.
And here you see the inevitable result. Just look at this chart, a spectacular rise, a vertical climb, followed by an absolutely devastating crash. The South Sea bubble popped, wiping out fortunes left and right, including, by the way, the fortune of Sir Isaac Newton. Turns out, castles in the air are built on some seriously shaky ground. The centuries roll by, technology marches on, but human psychology? It stays remarkably the same. So now, let's jump across the Atlantic to America for its most legendary bubble, the Roaring Twenties, and the infamous lead-up to the Great Crash of 1929.
In just 18 short months, speculating on the stock market became a national pastime. And how could it not, with gains like these? Just look at RCA. In a year and a half, the stock shot up over 400%. The feeling at the time was that a new era of permanent prosperity had dawned, and the only mistake you could make was not being all in.
And this belief wasn't just held by everyday folks. Just days, literally days before the crash, one of America's most respected economists, Irving Fisher, made this now infamous statement. He was a firm foundation guy, but even he got swept up in the mania, arguing that prices hadn't even caught up to their true value yet.
And then, that permanently high plateau just completely crumbled. The same stocks that had seemed unstoppable were now in total freefall. RCA, which had peaked over $100, plummeted to just $2.50. General Electric went from almost $400 down to $8.50. This wasn't just a market correction, it was an annihilation. The castle in the air had vanished, and the Great Depression was knocking at the door. And honestly, no one said it better. The show business newspaper, Variety, just captured the entire mood of the nation with this simple, brutal, and absolutely perfect headline.
The party was officially over. Now, you'd think that after these world-changing, catastrophic events, we would have learned our lesson. But the story, of course, does not end in 1929. We're about to see that even the so-called smart money, the professional, institutional investors, are just as human as the rest of us.
So, okay. After all that, surely we've learned our lesson, right? Well, let's fast forward to the 1960s and 70s, an era when the professional money managers really took center stage. Let's see if they did any better at avoiding building their own castles in the air.
The 60s kicked off with what was called the tronics boom. It was the perfect storm, right? You had a compelling new story, space, electronics, the future, and a herd of investors terrified of missing out. The game was simple. You take any company, slap a futuristic-sounding name on it, like geophysics or hydrospace technology, and you watch its stock double on the very first day. It didn't even matter what the company actually did. The story was everything.
And next up was the conglomerate craze. This was a bubble driven by one magic word: synergism. This was basically financial engineering that was disguised as pure genius. The idea was that a company with a high-flying stock could just go out and buy a boring, stable company with a low stock price, and then, through some accounting wizardry, its earnings per share would magically go up. It created this illusion of growth, and Wall Street pros, they just ate it up, even though no real value was being created. So after those speculative bubbles of the 60s crashed and burned, professionals ran for what they thought was safety, the Nifty 50. These were supposedly one-decision stocks. You just buy these blue-chip companies and hold them forever. But what that did was create this massive institutional herd. Everybody had to own them, which drove their prices to levels that were completely unhinged from reality. I mean, look at Polaroid, trading at 90 times its earnings. The pros weren't immune to the madness. This time, they were leading the charge.
The valuations were, there's no other word for it, absurd. At its peak, Polaroid traded at 90 times its annual earnings. For that price to make any sense, the company would have needed to grow at an impossible rate, forever. It was a castle in the air. Just this time, it was built with blue-chip bricks, and just like all the others, it was destined to crumble.
So, after all this, what's the big takeaway? From 17th-century tulips to 20th-century tech stocks, the story just keeps repeating itself. It's a timeless, powerful lesson about the madness of crowds. When you really look back at all these moments, you see the same psychological triggers firing off every single time. It always starts with a compelling story that ignites a fear of missing out. That leads to a herd mentality, and that incredibly dangerous belief that this time is different. Then price is completely detached from any firm foundation. Everybody gets involved, from the total novice to the seasoned pro, and it always ends the same way, with a sudden and painful crash.
And if you need any more proof that raw intelligence is absolutely no defense against crowd psychology, look no further than Sir Isaac Newton. We're talking about one of the greatest scientific minds in all of human history. He got swept up in the South Sea bubble, and he lost a fortune. His conclusion here is just such a powerful warning for every single one of us.
And that really leaves us with one final thought. You know the saying, history doesn't repeat itself, but it sure does rhyme. Speculative bubbles are going to happen again, so the next time you hear a story that just sounds too good to be true, the next time somebody insists that this time is different, I want you to ask yourself, are you looking at a firm foundation of value, or are you just admiring a beautiful castle in the air?